What I'm deploying is the buy and hold, buy the dips, get the undervalued assets. We are completely mispriced right now with commodity to stock ratio and all these different ratios. If we were to go to a more expensive end, like flip it, I don't think people understand what that means in terms of returns. And I just don't think the strategy of trying to take profits in the shorter term, I don't think it can beat it. Not even close.
Hello everyone and welcome to another edition of Triangle Investor Interviews. I'm your host Lucian Valkovic, and before I announce my guest, just a reminder of a disclaimer. This interview and all my interviews are not a recommendation to buy or sell any shares, products or services. Always do your due diligence and consult with your financial advisor. My guest today is Andy from Finding Value Finance. Andy, it has been a while. Welcome back.
Yeah, thanks for having me on. Really appreciate it. So thank you.
Yeah, you were in on my show. I checked; it was January 2nd, right after the new year. So we have a lot of things to cover today. Let's kick things off. Can you share your high-level perspective of the stock and commodity markets as of today? I mean, what major trends, cycles, or interconnections between these markets are shaping your outlook, and how do they influence your value investing strategy?
Yeah, so I think the value is still over in commodities. I think we're going through, which is hopefully a topping pattern in the overall stock markets and the Nasdaq, the S&P. I think eventually inflation and interest rates will weigh on the overall markets and they'll trade more sideways than going up that they've been doing. Commodities will be the benefactor of an increasing interest rate environment. I think money flows will go into commodities, which is the undervalued sector, like I thought it, like I always thought it was going to occur. And the values, it's all in commodities still. When I look at the markets, I'm just kind of waiting for things to slow down in the Nasdaq S&P 500 because that's where the overvaluation's at, and have enjoy at least at some point enjoy the money flows coming into the undervalued sector that where I'm located, which is commodities. Overall, I think the bear market low was 2020 for commodities. I think we had a big wave one in Elliott wave. There's a five wave up move in Elliott wave. I think we've completed wave one. We maybe or at the bottom of wave two, and then we're going to start wave three is kind of where we're located. The big moves occur when the stock market stops getting more fresh money. So I think that's when we'll really take off in precious metals and all the commodity stocks.
Agreed, Andy. Agreed. You are known for using ratios like gold to silver to spot undervaluation. Are there any lesser known or unconventional ratios you are developed or explored recently, let's say, perhaps involving uranium or industrial metals that you haven't shared publicly before?
Yeah, there's some opportunities I think in coal. So Newcastle coal futures are really cheap. You compare that to gold, the ratios are incredibly attractive at this time right now. Metallurgical coal looks really good from a ratio perspective in relationship to gold and other asset classes. So I think metallurgical coal, I think thermal coal looks really good. I also think in the future they've got good good ability to increase, the production of both to generate more electricity, which is needed for what I think the world is coming into, artificial intelligence, an electrical based world, more battery electric vehicles, more things that are driven by electricity. So those are, I think, a really good location. Iron ore, I think, looks decent. That looks like it's trying to bottom and turn higher. That is also cheap. So I think that looks good. That a lot of people don't really talk about. Um, So I think those are kind of the main three. Lithium's doing a big bottom as well. I think that's pretty cheap. So I think that's in the bottoming phase and starting to turn higher. Rare earth metals looks very good. That's probably at a cycle bottom is what I'll call it. Um, so those are a couple there that I don't think get too much attention. Fertilizers are good too. Fertilizers are cheap. They've bottomed, starting to turn higher. So if you were to sum it all up, there's a possibility that we're kind of shifting from a more precious metals fear trade, risk off, more towards risk on, um, more the inflation sensitive assets, because these are all inflation sensitive assets that I just named. The coal, lithium, fertilizers. I mean, those are all kind of the beginning stages or moves of inflation coming back and through the system. So I think those all look really good. Oil, obviously, I like oil, and people talk about oil a lot, but I think oil looks good too. And staying in the sectors that people just don't like and are uninterested in is where the values is at right now.
Excellent point. You mentioned fertilizers. What's your take? I wanted to ask you that, but I will ask you now. What's your take on potash as a commodity? How do you see it going forward?
You're saying potash? Is that what you
Yeah.
said? Well, the one I like is urea ammonium nitrate and ammonium. So the reason I like those is because the charts have more of an explosive move. You get larger moves than say potash. Potash is good. There's nothing wrong with potash, but I like ammonium and I like urea ammonium and nitrogen and stuff like that. Historically, if you look at the last bull markets, some of the companies that traded in those sectors did absolutely astronomical things. We're talking like 50 to 100 times increases. We didn't see the same type of movements necessarily in some of the potash companies. And ammonium is also used as a fuel. So they may, which I think we're going to move in this direction. I think they're going to use ammonium to fuel the big shipping, the big ships. So they're looking at that, and I think there's a big opportunity in ammonium at this time. So I think oil is going to squeeze so hard that we're going to look at alternatives, and the alternatives are going to be ammonium, uh, obviously electrical based stuff. So uranium is going to do incredibly well in that scenario. So I'm in the camp that we're going to oil is going to get squeezed enough, and maybe even perhaps natural gas, maybe within the next 5 or 10 years, that we're going to have to start look at other energy fuel sources. So ammonium's the one that really gets me going.
Interesting, very interesting. Andy, we
Mhm.
always talk uranium on my show. I want to talk uranium today as well. Where do you see uranium in the bull cycle? Where are we now?
Yeah, so I talked about Elliott wave earlier. Wave one, wave two pullback. I think we're coming off the bottom of wave two into wave three. So we're off the bottom. We're in moving into wave three. Wave three is the largest, the longest and biggest of the waves. It may not be the largest percent wise because some of the uranium companies came off bottoms that were pretty low. So wave one on a percentage term might have done quite well, but wave three is generally the biggest. I think that's where we're at. I think a lot of other sectors are at wave two going into wave three, just like uranium. So it's all I think they're all interconnected. I don't think uranium is necessarily going to go into a bull market all by itself compared to a lot of the other commodities. I think they're all going to run together. So I think we're coming off wave two, going into wave three. Doesn't mean we have small pullbacks along the way, but the big move is underway, and we have a long way to go. I'd really like to see the overall stock market slow down because I think we'll get a lot more money coming into the commodity sector from both bonds underperforming and the stock market underperforming. But right now, stocks continue to go up. I wouldn't have guessed that. I thought, man, we're getting close to a top, and I thought for the most part that we would have topped by now. But it keeps going up, and there's nothing I can do about it. You just have to sit and wait. for it to peak out or whatever it does. Maybe it has a blow off top, but commodities do real well when the stock market grinds sideways.
Yeah, definitely. What about silver? Silver is a big enigma. It's unpredictable. You would agree with me, I believe. How do you see silver going forward?
Well, I love silver. I think silver is going to do incredible things if interest rates continue to go up. I think silver is going to be this one of the spots to be. I think gold, silver, platinum, even palladium, I think looks good. I think they're all going to do incredibly well if interest rates continue higher. We saw that from 1940 to 1980. So during that time frame, silver did incredibly well. It went from very, very low level, it broke a downtrend, and then it went all the way up to the peak of 1980. It was insane how much it went up. I think that's going to happen again. I think we're going to break this big cup and handle, which is a consolidation pattern on a declining interest rate environment. So it's going down, down, down with interest rates. If rates continue to go up, which I think they will, silver's going to do incredible things. Multi-$100, maybe even more.
Yeah, let's hope so. I like silver as well very much. Many investors use ETFs for commodity exposure, but you have emphasized before direct investments or royalty companies. What specific risks or influences in commodity ETFs should retail investors avoid? And how do you recommend gaining exposure instead?
Yeah, so I own some ETFs. The only reason I want to go into individual companies is because I think they're more leveraged to the price move than an ETF is. An ETF puts a lot of stuff in it that maybe they're larger companies that will not give you the upside leverage. So, for instance, like a Chevron or an ExxonMobil, they generally underperform the commodity itself. They don't keep up with, say, oil. So, oil could do a 10 or 15x during a commodity bull market, and those companies may do like a 3 or 4x. You can find companies and gain exposure to the commodity that has leverage to the commodity. So they may do 2, 3, 4x of what the commodity does itself. So I prefer to put more money and have an exposure to those that have more leverage to the commodity price than going into an ETF that underperforms the commodity itself. So if I were posed with options of what to choose, I would choose physical metals over, say, an ETF because the physical metal historically has outperformed a lot of these ETFs. So I'd rather just choose the physical metal, take less risk, get it out of the system, and perform well. If I'm going to take risk, I'd want that risk to be rewarded more so than the physical metal itself. So my hurdle rate is the physical metal. So if I go and I invest, I want something that's going to give me in return a multiple of the physical metal or of the commodity. So that's why the ETFs, I kind of have money in them, but I only because I'm in an account where I have to go into ETFs. Otherwise, I would rather choose physical metals for my safe play and then more so into the equities, individual equities that will give me more upside exposure.
Smart advice. Andy, are there any commodities that you are avoiding, not just for overvaluation, but because of structural changes like shifts in global trade or energy policies?
It's a good question. Any commodities that I'm actively, there's some commodities that don't go up very much during bull markets, and they can be more easily um, fixed. Some commodities they have a problem. You can't fix it very quickly, like uranium, for example. Permitting times, time to market, I'll call it the manufacturing lead time or the mine lead time to fix the problem. So the ones with the shortest lead times to fix, at least my perception of it, are soft commodities, and I kind of avoid soft commodities. So I don't put a lot of money towards anything that's a soft commodity like wheat, corn, soybeans, and stuff like that. They can grow those, and there's crops, and I just don't think historically they haven't necessarily gone up as much as some of the metals. So I stick with whatever is difficult to solve, where you get a large mismatch and you can get a big deficit. So places like uranium, oil, oil's somewhat fast, but it's still lagged. In a lot of the metals where there's mining permits and stuff, it's tough to respond quickly. So that's kind of where I focus, and then I avoid soft commodities and stuff like that.
Yeah, you've linked real estate cycles to commodities, if I remember correctly, but have you identified any new synergies between commodity cycles and the other asset classes, maybe? Like equities or bonds that could guide investors or when to pivot into or out of the assets like you said silver uranium.
Sure, yeah. So what I found was that when money comes into the system, it can come into the system through two ways: fiscal spending and monetary bank lending. Historically, if you look back, a lot of these cycles were driven by bank lending, and that deals with the real estate market. That's where the majority of the loans come into the system. So right now, it is a little bit different than what it has been, say, like the 1970s. We have more fiscal spending driving it versus monetary bank lending. But that doesn't mean that monetary bank lending isn't occurring. It's still occurring, it's just not the main driver. If they were to lower interest rates, they being those who control interest rates, and rates were actually to go down, I think we would see more bank lending, monetary bank lending. But right now, they've kind of slowed monetary bank lending, but they continue to spend on the fiscal side. So that's one of the main drivers there. These cycles, basically, money comes into the system, it puts everything into a shortage, so to speak, and then it kind of exposes the weak points in the system. So the weak points in the system when money comes flooding into the system uh, have been, if it's under a real estate market and we're really starting to boom, has been commodities because we have to grow the commodities in relationship to the money supply that comes in. So each time historically we've seen a restriction in commodities, and then money comes into the system and commodities can't grow. So the money floods towards the commodity sectors. I think that we're in a very similar situation. Um, we're about to start this, I would say, any second, that wave three, where we have restrictions in commodities. It's across the board. It's uranium, a lot of the metals, oil, all that stuff, and that will start an inflationary cycle. That inflationary cycle, it's money coming into the system and commodities not being able to keep up, causes the quote inflation. So
Ye-
I think the most powerful commodity bull markets exist when other asset classes don't work and commodities are the only thing that works, or precious metals and commodities, and combine those two together. So if we see bonds not doing well and stocks not doing well, that money is going to be flowing over into commodities and precious metals, which will give us an extra kick in the pants to the upside. That only occurred in the 1970s for the most part. Otherwise, you've got multiple asset classes that are doing well at the same time, and the commodity bull market isn't as big. Kind of like 2000s, the 2000 bull market was big, but it's it wasn't like the 1970s for some of the asset classes. So I think what's coming is going to be, at least what I hope is coming, is that we're going to see stocks trade more sideways because of the overvaluation, and money's going to not go into bonds because of the increasing interest rate environment and inflation, and then the recipient will be more precious metals and commodities. It just hasn't happened at this exact moment yet. I'm waiting for that stock market to peter out a little bit.
yeah, Andy, I got to ask you about AI and data in cycle analysis. With advancements in AI and big data, have you incorporated any new tools or data sets to refine your commodity cycle predictions? And how do they complement your traditional ratio and technical analysis?
Yeah, so I don't think artificial intelligence is necessarily going to ruin anything. It may even amplify it if you think about it. Um, what I'm really deploying, it's like I'm not making a prediction. I just go where things are cheap. And right now, commodities are basically almost as cheap as they've ever been, looking back in history. So you could say it's more like a Warren Buffett approach because the ratios tell me what's cheap in relationship to history. And then you just have to kind of sit and wait in that area. So commodities are cheap to financial assets. Financial assets are incredibly expensive by whatever metric you want to use, CAPE ratio, PE, or Buffett indicator, all these different indicators. But that doesn't mean it will just stop, turn, and roll over. So AI, artificial intelligence, if you think about really what technology does and what AI I think will do, is it eliminates or reduces the lead time to create a product. And to create a product, you still need commodities and energy. So if we're at the cheapest time in history from a ratio perspective or valuation perspective for commodities, and you're at an expensive for financial assets, and you're about to have artificial intelligence come in, consuming copious amounts of energy, and at the same time trying to reduce the, we'll call it the friction of developing, making, and producing products. I can buy positions in commodities at the cheapest time in history at the same time that we are about to reduce lead time of developing, producing, manufacturing of products. So if we can play this right, the way that I kind of view it, and I don't know if this is the correct view, but at least it's my opinion on it, is that businesses around the world, if artificial intelligence gets advanced as what these people are predicting, well, ultimately that all value will go away from business because business, for the most part, like manufacturing companies, would just basically bankrupt each other because technology is improving so quickly. Um, and that all the value is going to be transferred to those that own the wealth, which is commodities, commodities and energy. Those are the two things combined in certain designs that we buy, like computers and TVs and cars and whatnot. But if artificial intelligence is going to change all those designs and change whatever, basically you just want to be in the ingredients for AI to make these products, the way that I view it. And if I can buy this stuff at the cheapest it's ever been, I don't really see a huge downside here. It seems like a pretty good play. So I'm just curious if artificial intelligence is going to bankrupt the very companies that produce it. Because,
Yeah.
I mean, if it's as advanced as it is, then why do we need those companies?
Yeah,
AI will
all
figure
good
out a better
points.
way.
Andy, your audience asks about entering commodity cycles, but what's your process for identifying and acting on cyclical peaks in commodities like uranium, gold? Are there any specific signals that you are watching, let's say in this year, in 2025, to exit positions with profits, of course?
Well, so I think we're in a secular. So secular is the big trend, the big 10, 15, 20, maybe even longer than that. Could be the rest of our lives. So the big trend is up for commodities. Now, cyclicals, the smaller, shorter term pullbacks that happen, 6 months to 3 years, something like that's the small kind of like pullbacks. I am not playing the small pullbacks. I'm just playing the big secular trend. I'm using the pullbacks to gain entry points. So basically, I'm buying the dips and holding the rips is what I'm doing. And it's really, really boring. A lot of people think that they need to do something. I think by trying to time the shorter term, smaller cycles, you're going to reduce your overall returns, especially if it's under a year, because then you're going to pay a lot in taxes. At least in America, we do, and depending on what account it's in. So I understand that people want to do that. It makes sense from like an emotional standpoint that you don't ever want to go through pullbacks and feel that. I just don't think you're going to be as successful as someone who holds through the whole thing. I know
So
it
you are
seems
not
like there's could
using
be
investor sentiment, behavioral biases, herd mentality, fear-driven selling. I can go on.
Yeah. So that, well, here's the thing. All of that is, it's not as predictable. So what you're doing is you're trading, you're saying, I don't want to hold for the long term, which, I mean, if you look at some of these companies, I'll give you an example. All right. Go pull up Centrus Energy, and that's a uranium company. It's one of the few that makes, I'll say, earnings and stuff like that. Go look at the 2020 bottom and go look at where it is today. It's up hundreds, not hundreds of percents, 100x plus is what it's up. Now tell me a strategy where you can beat that. There is none. And I know I'm cherry picking one company, but what I'm saying is there's a lot of companies that are going to do what Centrus has done. And still in commodities over the entire bull market, which I think will last probably into the 2030s. So I don't think there's another strategy that can beat that strategy. So what I'm deploying is the buy and hold, buy the dips, get the undervalued assets. We are completely mispriced right now with commodity to stock ratio and all these different ratios. If we were to go to a more expensive end, like flip it, I don't think people understand what that means in terms of returns. And I just don't think the strategy of trying to take profits in the shorter term, I don't think it can beat it. Not even close. So the people who've made all of the money, there's certain traits that all of them exist. Those traits between these people making lots and lots of money in the stock market, all of those traits was they invested in a bunch of companies. A few companies made the majority of the money. And what they did is they just never sold or they held very long. And they held it for not just 100x. They held them for 1,000, 2,000, 10,000x returns. So I'm not stating that that's what we're going to do in the commodity bull market because there's going to be an end to this cycle at some point. I just think that we are so early that trying to time the short term lower probability bet, like lower probabilities of timing is very tough to do, and I don't think you'll beat the strategy. What moves markets in the short term is exactly what you said. It's sentiment, it's news flows, and money flows shift based off of sentiment, news flows. And I just don't think there's a good way of timing that. So I don't
Okay.
do it.
Yeah. Final question, and the cash position. Do you believe that we should hold more cash today than, let's say, a year ago or something like that, in expectation of a pullback? Or how do you approach the cash position in your portfolio?
Yeah, so if I think there's a good opportunity that is cheap, I will buy it. It may not be the exact absolute bottom because timing the absolute bottom's, I think, impossible. So if there's an opportunity, it's there, I take it. So I don't sit on cash hoping that there's going to be a better opportunity out in the future if a really great opportunity exists today. So I think this year in 2025, I thought we had a whole bunch of opportunities all throughout April, May, June. I've been deploying cash in a whole bunch of different sectors. Some of those that I talked about earlier that maybe people aren't really looking at, like coal, like met coal, thermal coal, lithium here recently. I think there's a lot of good opportunities, and my cash position is not very big. I've been buying whatever's down and has a good chart and is cheap. So I've been deploying. But there's some people who may not have like an income. So I'm making money from things and dividends and all that. Um, I would say if you don't have, any money coming in, then maybe you want to keep a cash position just in case.
Fair enough. Fair enough. Andy, how can people reach out to you?
Yeah, you can meet me or you can join me on finding-value.com. We do Q&A sessions, which is face to face like this, so you could meet me in person too if you want to sign up. Special coupon code, or you can follow me on YouTube, finding value finance, and then Twitter finding_finance. You can find me there as well.
We will leave the links in the description of this video. Andy, thank you very much for this interview.
Sure. Thanks for having me.